Chapter 11, Acquisitions, the Secret of Quantum Growth. For the high performer, arithmetic growth is unacceptable. Geometric growth, exponential growth, is demanded. Throughout this book, we've talked again and again about quantum growth and making your quantum leap to becoming super successful. And by the way, enormously wealthy. In this chapter, let's nail down the specifics of quantum growth and the best way I found to achieve it through acquisitions. But first, I want to discuss a minute on one of the most abused words of the current generation. Success has almost become a cliche in a world where everything is relative. The feel-good mooches in the seminar circus will assure you with a straight face that you are a success if you feel better about yourself, if you've achieved harmony. Hell, these days you can be successful if you're happy shoveling horse dung or if you achieve contentment living under an overpass. We don't want anybody to think they're a loser, that they're basically worthless to themselves and society. In more and more elementary schools, so-called educators are banning competition sports, or at least no one keeps score. That way, no child loses and everyone wins. The precious little self-images are preserved through artificial success. What kind of preparation is that for the real world? Thanks to such inverted thinking, nowadays even failure is success. George Orwell's 1984 has come to pass on the playground. Editor's note, in this day and age, in 2017, almost the summer, this is even more prevalent than it ever was when I wrote this several years ago. Now there is no first, second, and third place. Now there is just one medal or ribbon for participation. End of editor's note. In the 90s, a snake oil artist on a seminar circuit who charged $7,000 a head for taking all your assets away so you can learn to live with nature in abject poverty. And the morons bought it. It should be illegal to be that stupid. So let's get back to reality. The only success in life, and especially in business, is that which you can quantify into measure. Otherwise, you're playing word games. I define success in terms of the most universally accepted qualifier of all, money, cash. Nobody argues with cash. Money talks and bullshit walks. If you're making quantum leaps and pulling down millions in personal wealth, and a lot of people are doing it, you are without question successful. Remember in chapter 1, we discussed people who were uncomfortable talking about money. That's because the morons never had any to talk about. You've got to become as comfortable with lots of money as you do with success, because real success begins with real money. Let's define quantum growth by what it's not. Quantum growth is not making more sales than last year, or picking up new clients, or adding more products or stores or branch offices, or reducing costs. All of those are indicators of growth, all right. Internal growth, and more to the point, arithmetic financial growth. We've already talked about this. 1 plus 1 equals 2. 2 plus 1 equals 3. The healthiest internal growth in any business is always going to produce only gradual, long-term arithmetic growth, nothing more. Why do entrepreneurs settle for gradual, boring growth? The best that can be said for arithmetic growth is that it's better than no growth at all. And in fact, if your company is only growing arithmetically, it's probably dying. But why does an entrepreneur, an uncommon individual who once had a bold vision to build a company and worked days and nights to see this vision come to life, why does this same person now accept the humdrum growth of 4% better sales than last year, or a 2.5% higher profit margin? It is not as if the person has never known quantum skyrocketing growth. The fact is that in the beginning, the founder of a successful company did experience quantum growth, and it's exhilarating. He no doubt spiraled from zero to enormous success, maybe growth in the hundreds of thousands of dollars in the first year of business. And business was new business. All money was new money. The growth curve shot almost straight up and soared across the chart like a comet. Then inevitably the company settled into a routine. The entrepreneur became a manager and not mirrored in sales figures, group insurance and payroll. The growth curve flattened out. The comet fizzled, and once bold adventurer accepted it all as part of owning a business. After all, the other companies in his industry were doing about the same, so everyone was successful. Actually, everyone was satiated. This became part of the less than all you can be herd. Their expectations settled into average. Average, God, how I hate the word. If I continued to drill wells in Wyoming in 1984 with all the capital we got from the public offering and pumped out a respectable number of barrels of oil, our engineers had projected Great Western would have grown internally, gradually, arithmetically. Our Great Western shareholders in the UK, still clutching their prospectuses and getting their dividend checks, would have been happy as pigs in shit. Look, we made 12% on our investment. Those noisy Yanks are a bit of all right, after all. But punching hundreds of holes in Wyoming was not where I wanted to take my company, myself, and my shareholders. My vision was light years beyond theirs. I knew that quantum growth, kind of warp speed financial performance I wanted, would only be achieved through external growth. And as I said, external growth is only possible through the series of equity transactions. Let's examine the difference between what we'll call a product transaction and an equity transaction. Product transaction is essentially an even trade. The product produced by an almost even trade of goods for money is negligible. We use the term profit margin because the damn profit may be a barely visible sliver of the whole transaction. So salespeople have to do a zillion product transactions to generate substantial profit. An equity transaction, by contrast, creates value. A board of directors decides to sell equity to raise capital. It votes into existence 500,000 shares of common stock for a public offering. When shares sell, value has been created from nothing but the perception of value. Investors, in fact, are buying not a product but a future value that may exist. It's sort of like buying thin air and paying cash up front for it. The downside, of course, is that the company cannot go on diluting its ownership indefinitely. If you're not willing to risk everything you own, don't try to buy a business. Accordingly, the equity transaction, which is a real secret of quantum growth, is acquisition. The purchase of equity assets, which enables a company to multiply the net worth geometrically so that it can be turned around and sold to generate a ton of money. The first years of new century, one of the rages among seminar gurus in the U.S. was real estate investing, which is code for buying and selling cheap residential properties or flipping houses with little or no money down. Those so inclined could buy fixer-uppers, slap on some minimal improvements, sell them to the next buyer, and make a quick profit, a few $1,000s. Then around 2004, the prices of residential real estate began to skyrocket out of sight. You remember how it was? Greedy investors, large and small, bought houses as their value ballooned beyond all reason. Banks joined in by offering subprime interest rates to buyers whose avarice outran their common sense. Then, bust. In the rest of the first decade of the 21st century, the real estate market stagnated. Home values tumbled, so those inflated home deals that seemed too good to be true turned out just that. There were more for sale signs than trees in some markets. In 2008, the big lenders who had been so cavalier with their loans went down the tubes. Bear Stearns, Fannie Mae, and Freddie Mac, only to be rescued by the federal government with taxpayers' money. AIG was saved by the intervention of the Federal Reserve, who agreed to lend up to $85 billion to AIG in return for 80% stake in the company. Thankfully, that was an election year, and Congress vowed financial relief for all the ignorant morons who lost their ass and their home to the landmines of subprime mortgages. But even in the best of times, these types of investments are only the beginning, not ends in themselves. Flipping houses are the poor man's equity transaction. How infinitely more lucrative is the equity transaction in which a company is acquired for, say, $5 million of other people's money, OPM, pumped and prettied up and sold for 10 or 12 million. The perils of the leap. If you're contemplating your first business transaction, you need to approach your venture knowing in advance the 3 greatest personal hazards you face. Having the will and determination to clear these hurdles, as you recall from our first 4 chapters, it is what becoming a super successful high performer is all about. Here are the three hazards. Number one, the depth of personal commitment required. Your acquisition deal must take precedence over normal personal considerations. You have to make a total commitment of time and energy. Buying a business, especially the first business, is a full-time proposition. If you are trying to hold a job at the same time, you'll either have to quit the job or give up making your quantum leap through acquisition. You'll be spending days and nights figuring, refiguring, analyzing, and strategizing, and then doing it all over again. Because if you do a half-assed job of the planning and calculating every step and every nitpicking detail, you're likely to fail. All this means no days off, no vacations, constant travel, and continuous meetings. Remember my doofus test, which put a prospective associate under pressure? When you're working on acquisition, your whole life is a doofus test. You sleep on your couch, eat at your desk, work on your bed. Your lawn goes to hell. Your friends think you're crazy, and your family stays mad at you for ignoring them, forgetting their birthdays and missing their recital. You must have commitment of support from your family. If not, you'll have to make a decision, your quantum leap or your family. I'm not fooling around here. When I hold my week-long seminars at Guthrie Castle, I stress the importance of couples attending, wives or significant others, because the depth of the commitment required is such that the other in the personal relationship must be a signatory to the quantum leap his or her partner is about to make. On occasion, the castle attendee has ultimately divorced his or her spouse or business partner because the other person was unwilling to make correspondence and commitment to that dream. 2, the total financial risk involved. You must be willing to make a total commitment of your financial resources, to put everything you own on the table. Sure, a lot of other people's money is available, but many sources of OPM are looking to see how willing you are to lay your resources on the line first. Mark this sentence: if you're not willing to risk everything you own now and in the uncertain future, don't try to buy a business. If you can afford to, or are unwilling to risk your savings, your home, your car, your child's education, everything you own, find another way to earn a living and file your dream under nightmares I have avoided. 3, the degree of stress you must endure. Here's an important reason why I practiced being a super successful high performer long before I achieved my greatest success. I knew from what I saw and from what others told me that the quantum leap would be no picnic. I knew I would have to suck up my pantyhose, act tough, slash enemies, take hostages, and kill prisoners to reach my goals. I knew almost instinctively the pressure would be enormous to evocate, to compromise, to surrender. I foresaw times when, unless I practiced, I would be too wound up, too stressed out to beat up, or just too damn tired to take action in my best interest. So I practiced. I thrust myself intentionally into one uncomfortable situation after another. I led charges when others retreated. I picked fights while others prepared to surrender. And except for a few modest vices, I've kept my body and spirit in peak fighting condition for more than a half century. In Texas, where I battled with the energy giants they called Dan Twisted Steel and Panther Piss, amongst other things. Sooner or later, stress can kill most people. Stress, no doubt, contributed to the loss of my dear friend and partner, Charlie. But the fact is, life eventually kills us all. My feeling is that no blasphemy intended. Life after death isn't so important as life before death. So I live the son of a bitch, play the cards, and seize the day. Stress be damned. I give ulcers, I don't get them. If you can't handle stress, if your health is of more immediate concern than your quantum leap, move away from this terrible chasm. Once again, it isn't for everybody. How to find your first acquisition. We've discussed in detail the process of raising capital for the purpose of acquisition. But well before you arrive at the point of beginning to interview capital sources, there are several basic issues you need to clarify in your own mind. You're an energetic, ambitious individual with a 3-digit IQ who sees less capable people than you run successful businesses, live in a luxurious lifestyle, then suddenly sell their company and retire early to a tropical island. You're an employee now, maybe, but you have an imagination, self-discipline, and chutzpah to run your own business, and you're tired of working your tail off to make your boss rich. Your first question, what kind of business? I have some guidelines for answering that question. First, as I preach to my disciples, stick to your knitting. Look for businesses in which you already have expertise. You'll face enough problems, not challenges, borrowing capital, assembling your dream team, taking over your company, and learning to become a CEO without having to acquaint yourself with the technical process and jargon of a whole new industry. Do what you know. Later, after you've made several quantum leaps and become more comfortable with the acquisition process, you'll see common characteristics and be able to handle acquisitions regardless of the industry, much as I do now. Do what you like as well. Regardless of the problems you run into, your quantum leap will seem less harrowing when you are making it in an area you know and from which you derive pleasure. There are other practical criteria too. You want to make your acquisition in the industry which is fragmented and dominated by mom and pop companies. You want an industry that's large enough to handle your acquisition aspirations. If you're planning to purchase one of 3 companies that serve what is essentially a limited market, such as a buggy whip repair or carbon paper manufacturing, you have nowhere to expand. You want industries that enjoy a 20 to 40% margin. In my own experience, these include such wisely diverse industries as retail jewelry, landscaping, building maintenance, publishing, home improvements, and trailer parks. If you get into the business with a 3 or 5% profit margin, you'll take forever to build your dream. Narrow your focus. You might be interested in healthcare, for example, but you need to find a niche no one else is consolidating, such as childcare or senior living. Editor's note, the margin that I speak of is gross margin. End of editor's note. The size of the business you want to acquire depends on the size of your goal and the clarity of your vision. My guess is that if you've read this far, you're looking for more than a steady income and a secure retirement from a couple of dry cleaner operations. I sure as hell hope so. I want you to be getting ready for the quantum leap to haul in an obscene amount of personal wealth. That means your acquisition must be in order of a large manufacturing firm or a distribution business that will catch the eye of an investment banker's. How big is a company? As a general rule, you as the owner can reasonably expect to receive income before debt service of about $25,000 from intangible services or consulting fees of $50,000. Which there is no inventory and usually no equipment beyond office equipment, about $25,000 from retail sales of $100,000, and the same from manufacturing equipment, depending on the degree of automation and the cost of materials. The bottom line is take some quality time to define exactly what you want before spending money and effort shotgunning the market. Ask yourself if you are more comfortable in consulting, retail, or manufacturing, to name but 3. Conducting your research. Once you've defined the type and size of business that meets your requirements, there are several avenues to take for locating likely prospects. The most important thing to remember at this point in your eagerness to buy is not to buy the first great deal that comes along. If you looked at the 20 houses or more before you purchased your most recent home, why would you grab the first business that sticks a for sale sign in your face? Even if you find the perfect sweetheart deal the first day or you search, shop around anyway. Take the time to analyze and compare several prospects, and so you'll know a great deal when one comes along. Editor's note, many years ago, T. Boone Pickens told me that, Danny, if you want a deal bad enough, you'll make a bad deal. End of editor's note. Begin by scanning the business opportunities sections of your local and regional metropolitan newspapers and the Wall Street Journal. If you don't yet subscribe to such magazines as Forbes, Entrepreneur, and Inc., my first question is why not? Get current copies of each of these and look for opportunities that match your criteria. Get copies of trade publications in the industry of which your prime interest, and check the marketplace and classified sections of the business for sale. Editor's note, Now with the internet, all this is made much more simple, and you can get this information online. End of editor's note. Contact local business brokers and explain in writing exactly what you're looking for. Otherwise, like real estate salesmen, they'll show you every listing from ice cream stands to funeral homes. Typically, the seller of a business pays broker commissions, so it should cost you nothing for a broker to help you during your search process. But don't sign any exclusive contracts. One of the largest business brokerages firms in the U.S. is VR Business Brokers, headquarters in Newport Beach, with almost 50 independent offices in 15 states. According to VR's chairman, Don Taylor, a professional business broker has the expertise to accelerate process leading to an equitable acquisition. Although VR brokers are reputable, my experience in over 25 years has been shabby at best using business brokers. I would advise extreme caution. Editor's note, and today in 2017, business brokers are even more shabby. End of editor's note. Sources of information abound. Ask your banker, your accountant, lawyer, industry supplier, wholesaler for any companies which might entertain a purchase offer. As an aside, an inside tip gives you the head start on any deal. The most direct approach is to contact a list of qualified companies directly. A lot of burned out owners are hiding in the corporate jungle, desperately wishing they could retire. You should be their salvation. In fact, you'll be amazed at how receptive so many business owners are, at least considering selling their business. My partner in tax consulting firm decided the best way to approach prospects in the industry was to cold phone call to the owner. He says that he frequently got a respective response to the effect, "Our company's not for sale. We're having a great year. When do you want to get together?" Another of my partners was an ambitious publishing entrepreneur. He sent out 240 inquiry letters to publishers he found, although through Dun & Bradstreet. The letter was intentionally vague as to the size and type of publishing companies he was looking to acquire. What it did say was that he was in the process of building a unique kind of publishing company. From the 240 inquiries, he got more than 80 responses, about 35% response rate. Of those, he qualified his pursuit list to about 50 publishing companies, which satisfied his revenue parameters, and whose principals wanted to discuss selling their firm. By the way, the first question many of those who called asked was, "What do you mean by unique kind of publishing company?" A little teaser on the bait never hurts. That partner has continued to refine this simple yet powerful inquiry letter. It is so effective that I have included it in the handout of my high-ticket Doing Deals and Acquisition seminar. As an added value, I've included it here for you in Appendix M, along with other letters and outlines used successfully by my protégés and partners, all at the price of this book. Want another example? The fired-up Philadelphia airline pilot turned entrepreneur sent me a copy of the letter he has sent out under his company Impressive Letterhood to prospects in his target industry. You could literally change the industry and price range and use it yourself. The letter is reproduced here below. Mr. Winchester Healthcare Clinical Labs, Corona, California. Dear Mr. Winchester, we are interested in acquiring a medical laboratory firm located within the greater Los Angeles area with sales ranging from $2.5 to $5 million. Our preference is for a company that supplies the needs of most local physicians. However, we are flexible and will consider other opportunities. We are principals, not business brokers, with adequate capital and financing, and we're prepared to close very quickly on the right situation. If you have an interest in selling, please call us at your earliest convenience. You have our assurance that all matters will be held in strictest confidence. We enclose our business card for future reference in the event you have no present interest in selling. Of course, we would greatly appreciate your directing this letter to any of your colleagues within the field whose business may be on the market. Sincerely, name Managing Director. Every element of this letter nurtures the perception of his company as a large, professional, well-financed organization. He assures the reader he's not a broker fishing for leads, that he's got capital in the stacks of large unmarked bills sitting on his desk, and that he'll buy immediately if the company and terms are right. Hey, if I were Mr. Winchester and wanted to say, screw it, I'm retiring to Barbados, I'd pick up the phone in a heartbeat and call this guy. One of my finest deal hunting partners was an Aussie named Martin Heller. Martin was already a committed entrepreneur, but after listening to my tapes, attending my seminars, and reading the first edition of this book, he decided he was ready to hunt with the big dogs. Here's what his letter wrote. By the time we meet in London Hotel in December 2000, I had fully absorbed his mindset. I felt I knew him very well already. Dan had formed the Guthrie Group, an investing consortium specialized in facilitating transactions. I was determined to join them. Many doofus tests later, and after 3 months of investigation, he finally made me an offer to join the Guthrie Group. I stayed with the group for over 5 years, lived in the castle for a time, and eventually became one of the principals. Dan taught me how to best hunt for deals. We had over 100 meetings that I set up with banks, venture capitalists, and private equity firms. We interviewed CEOs, assessed acquisitions and divestments, MBOs and SMBOs. We worked on industry consolidations, and all of us working together sent thousands of emails. It was a hard graft, but excellent grounding. Whilst no two deals were the same, the credos for success Dan teaches never change. For anyone interested in super success, I recommend Dan's training exclusively. Few individuals come close to his attitude or knowledge in business. Classic comments like, super success is not for everyone, and if you want a friend, buy a dog, are very unlike those happy, slappy, feel-good seminars. More important, they reinforce the fact that without a series of pay price to action, without grit and passion, in his words, you can forget about it. Selling the seller on you. Most business owners, particularly those who have founded and grown their own company from scratch, are very protective of their baby. It is their baby, and even though they're entertaining the idea of selling it, they want that baby in good hands. They want their employees protected and secure. They want their customers taken care of. The first question they are going to ask, at least in their own mind, are, who are you and how do I know you can run my company the way it should be run? They do not want to sell it to a kamikaze pilot who's going to drive it into the ground. That's why it may be best for your lawyer or your Big Four accountant to make the initial call on your behalf to get instant credibility. Or if you prefer to make that first call and you detect those questions bubbling around, offer as reference the names and numbers of your lawyer, your accountant, and maybe one or two of your directors whose names he may recognize. Once the prospective seller has chatted with your man at Deloitte & Touche or Ernst & Young, you can bet his diligence is done. Another method that is equally good is to send a short letter which includes the profiles of your board of directors, much as you did when seeking your accounting firm. This also gives you instant credibility and should remove any hesitancy on a prospective seller's part. What if your prospect cuts to the bottom line just to see if you're serious? He says, well, I may be willing to sell. Are you willing to pay? You say something like, 3 to 8 times after-tax earnings, but of course, we have to look at the books. I probably do an acquisition audit, but we can talk about that later. You sidestep his probe with an answer that tells him that what the hell you're talking about, so don't ask any more stupid questions.